2026 has barely begun, and just 8 days in, the world looks no safer, no calmer, and no more predictable. Military tensions are flaring, oil supplies are at risk, stock markets are teetering, and national debts are ballooning to historic levels. If you were hoping this year would bring relief, think again. The warnings of 2025 are still here, but now they're more urgent than ever. So today, we're talking about the asset that stood the test of every crisis in 2025, as well as every war: gold. We'll explore why 2026 could be a make or break year for regular people like you and me. This is why owning real money, not paper money, has never been more important. By the end of this episode, you'll understand why gold behaves differently from stocks and currencies, how it protects purchasing power when systems come under pressure, and what practical steps you can take in 2026 to safeguard your wealth. Before we get into it though, remember to follow us on Spotify or Apple Podcasts so you never miss an episode. Today, I'm joined again by Gary.
Hi Jake, thanks for having me.
No, thanks for being back by popular demand again.
Thank you very much. Let's get going.
Let's get going. The first question, how does gold protect you from all this?
Well, gold is considered the equivalent of like a financial seatbelt.
Mm.
You don't put it on because you want to crash.
Yeah.
You put it on in case you crash.
Exactly that.
It's not like a certain, but it's a protective measure. So when currencies wobble, governments overspend, or markets panic, gold just kind of sits there and done what it has done for the last 5,000 years. It doesn't default, it can't print more of itself, and it doesn't need a government bailout.
So can gold really protect you and act as insurance against both stock market crashes and government debt, all these things that seem to be spiraling out of control? Can it really protect you from all of this?
100%.
Yeah.
I mean, that's his key point. You know, stocks depend on earnings, bonds depend on governments behaving responsibly, I guess, which is always a stretch.
Yeah.
Gold depends on no one. No central bank promises, no political press, conferences, and that's why it shows up when confidence is low and the markets are volatile. It's just a safe place to put money in times of uncertainty that gives a very standard but safe yield. So yeah, I mean, it's probably one of the top 3 reasons that people buy gold.
So in your specialist opinion, would you say that we are overdue a major stock market correction?
Overdue is a bit of a dangerous word.
Okay.
But let's just say the markets have been acting like calories don't count after midnight. Valuations are stretched, debt is high, and everyone assumes the Fed will save the day forever.
Exactly.
Historically, that kind of optimism doesn't end with a soft landing. Now, we've been on a bull cycle for years. Normally, it used to be a 8 to 10 year bull and bear cycle.
Yeah.
We're on a massive run here. So yeah, I would like to think that the markets are overdue a correction, recession, so on. So
just explain quickly for people who don't know what a bull and bear market are.
A bull market is when the market is rallying and going up, and a bear market is when the markets are coming back down.
Right.
So we've been in a bull run. So obviously there's peaks and troughs, but generally it's been a bull run for 20 years, maybe a bit less, 18 years.
Yeah.
Normally it used to be an 8 to 10 year cycle, but this is a massive bull run. So yeah, I'd like to think that the markets are overdue a correction, and that's why people need to be careful, because they're overvalued at the moment.
Yeah. And keeping it on stocks, we've got the Magnificent Seven, as they're called. This is Microsoft, Alphabet, obviously that's the company that owns Google, Amazon, Nvidia, massive AI stock.
Yeah,
Meta,
they're giants, they're beasts.
Yeah, Meta and Tesla. Now these dominate global equity markets and account for a massive portion of gains in the S&P and the Nasdaq.
Yep.
So would you say these are vulnerable, these tech stocks, and if so, how much?
Look, these companies are fantastic. They've changed the world. They've revolutionized industries, but they're priced like nothing can ever go wrong. And, you know, when 7 stocks carry the entire industry and the market on their back, that's not diversification.
Yeah.
Excuse the pun, but that's like a boy band. If 1 or 2 leave or stumble, the whole chart starts to look a bit more shaky and flaky.
Yes.
It's like, you know, if you've got boy band and 2 of the most popular leave and do their own thing or go solo, the boy band it ceases to exist.
Yeah.
And, in that case, the indices starts to shake.
Yeah, exactly.
But look, these are fantastic companies. They've had great yields for years. But we're getting to the point where their earnings are not as great. They're overvalued. So, yeah, people just need to be careful when purchasing, especially if you're purchasing a single stock.
Yeah. So, obviously, we're in a period of high debt and high inflation at the moment. Why do stocks generally underperform during these periods?
Because inflation eats profits and debt eats your flexibility. Companies face higher cost, consumers pull back on spending, and interest rates punish anything priced for perfection. Stocks don't love inflation. They tolerate it at best. And high debt, high inflation is never good for the economy. No. People are scared. Their money's not performing, or their money's not keeping up with inflation. So they're actually paying a stealth tax, even if some people don't see it. So that means they've got less money to spend in the economy. And when there's less spending, stock prices, it affects earnings. So it has like a domino and a trickle effect across the whole supply chain, from consumer all the way up to the big institutions that own like the supermarkets, so on and so forth.
So we've been sort of dancing with a recession for a while now. Some people have argued that we are already in a recession. But how did gold perform in the last recession, and how does it generally perform during recessions?
Well, gold did what it usually does. It didn't panic. While markets were having an emotional breakdown, gold quietly held its value and even eventually moved higher as central banks fired up the money printers, and guess what they were buying? More gold.
Yeah. What a surprise.
Demand, the oldest form of economics that we know. It done exceptionally well. Sometimes, like during recessions, we've seen 34% jumps. Last year, we wasn't even technically in a recession, and we saw a 50% increase.
Yeah.
So, yeah, I mean, gold during recessions and times of uncertainty is when the herd flocks to gold. It's when you want to get in before that.
So what role has gold historically played in stabilizing economies?
Gold has been the adult in the room. It's limit supply, politically neutral, and I guess universally accepted. You take your gold anywhere, you can swap your gold for whatever denomination of currency or whatever it is that you want. Gold will always be in demand. Even today, central banks still treat it like a financial fire extinguisher.
Right.
You hope you never need it, but you'd be crazy not to have some
one
nearby, or some to have in your portfolio, or in your pension, however it is that you want to purchase it. So it's been doing it for years. As we mentioned earlier, it's been on an upward trajectory. That doesn't mean it doesn't have peaks and troughs, but it's been on an upward trajectory for 5,000 years.
Exactly. Can't argue with that.
It's as old as time.
Yeah. So let's move on and discuss current events and a bit of geopolitical stuff.
Yeah. Crazy world.
Yep. Another crazy thing. US action in Venezuela. Yep. Have you seen this impact global markets at all?
Anytime energy supply, sanctions, or geopolitics gets messy, markets get nervous. That's just a fact. Oil reacts, currency wobbles, and suddenly the old boring assets start to look very, very, very attractive again.
Yeah.
That's why we're seeing record high gold prices, silver prices. Anything that's tangible and it's real starts to really ramp up. So, whatever your opinion is on Trump, whether you think he's been a great president, terrible, whatever it is, he is good for gold because he creates some level of uncertainty and unpredictability. And when that happens, people flock to gold.
Precisely. Exactly that. You mentioned currency wobbling briefly there. Does this strengthen the case for holding physical assets over paper ones, dollars, pounds, etc.?
Absolutely. When geopolitics heats up, people remember that paper assets comes with a counterparty risk. Gold doesn't. It doesn't freeze, it doesn't default, and it doesn't need permission. And you get a wide range of people buying physical gold in this case because they think the world's going to go to pot and they'll need it to barter for loaves of bread and water.
Yeah.
You get some people who, and this would be my opinion, are not of that opinion, but they know that they need something away from the centralized system that they have complete autonomous control over, that still sees a generous yield in a kind of risk-off asset. So yeah, I think that people really start to see the need for physical assets, especially gold and silver, as opposed to promises from a government that I'm not sure that everyone is wholeheartedly believing in at the moment.
Yeah. 100%. And we've spoken previously about central banks. They're buying loads of gold. Do you think this could trigger them to increase even more their gold reserves potentially?
They already are.
Oh,
Central banks don't buy gold because they're nostalgic. They buy it because they don't trust each other. And that is the big telltale sign there. Central banks have been buying up gold in small tranches, so it's not as noticed. Some are doing it just out in the open.
Yeah.
But the fact of the matter is they're increasing their gold to record numbers, and that's because they know what we know. There's uncertainty all across the globe, whether it's geopolitical, whether it's economical uncertainty, fiscal uncertainty. It's everywhere, and they know.
Yeah, exactly. For the listeners who have been watching the gold price for the last year, you could say probably more, and they're thinking there'll be a dip, surely. Why would you say that's not the best strategy with gold?
Because gold isn't or trade like a tech stock. Its biggest moves often happen, I guess, quietly when no one's watching. Waiting for the perfect entry usually means you're missing the move and buying later at a higher price. That's human nature at its finest. Like, we've had clients throughout the years now, and even myself as an account manager, who would speak to prospective clients and they say they'll hold off. And our job's not to convince you to buy gold, it's to make sure that you're getting the right gold for you, and to make sure that it's a seamless process. We had 52 all-time highs this year, not 52 all-time lows. So you were waited for something that didn't happen, and in the midst of that you would have missed out a 50% return if you'd have purchased even a small denomination bar or coin, or just got yourself some skin in the game. You will have reaped the reward of a 50%. If you bought coins, it'd be a tax-free profit. And waiting for the dip on gold is, if you're going to trade the stock and you're going to use a financial derivative like spread betting, CFDs, futures contracts, it makes sense to wait for a pullback of £20 so you can get in at a good entry, and your pound per pip is a good level. But if you're going to buy and hold a physical gold coin over the next 10 to 15 years for family stability or growth, whether or not it was up or down £20 that day, it's not going to matter to you. Because gold in January, whether it was 2,300 or 2,350, could you have bought that day right now, you'd be at a 50% increase or a 49%, whatever it ended up being. You'd still have made a right decent return.
Just a year.
And it's not like, right, listen, the gold and the returns this year is an anomaly. That doesn't happen every year. But you can put your money in gold and have a stable, because it's not as I said earlier, it's not the jazziest, it's not the sexiest of investments. This is a buy and hold asset. You buy it, you hold it, you sell it. Doesn't pay you dividends, but it's an asset that comes with limited risk, and the rewards are there for double-digit returns. Past performance is not a guarantee for future success. However, last year we've seen 60% return.
You can't.
It's an absolute fact. It's not an opinion, it's a fact. With limited risk, because, when was the last time gold lost 60% of its value, unlike Bitcoin?
So what is the gold supply looking like at the moment?
So supply of gold's tight. Mining's expensive. Discoveries are rarer. Meanwhile, demand from central banks especially is strong. And that's not a recipe for cheap gold in the future. That generally means prices rise, demand grows, supply becomes shorter because they're purchasing everything in that they can. Now, that's not to say that central banks are buying their gold from us. They buy it from other places, but it means that the supply chain, or the supply of gold, it's harder. We've had clients this year who have waited patiently for over 3 months for their gold. And I say patiently because they've been fantastic in understanding that it has been a bit of an issue getting mass numbers of gold coins or bars, especially towards the latter end of this year. There has been supply chain issues, but our clients have been fantastic in understanding that. So yeah, I mean, the supply is starting to get better because the supply chain starts to understand it. When it's a shock and there's a massive surge of interest and demand straight away, it's not built for it. Not that it's not built for it, but it's not ready for that kind of demand level. But where it's now, that's just the norm. It's now become accommodating to that fact, and it's a lot easier. And we're seeing delivery times, even to us, to our clients, a lot shorter.
Great.
But yeah, the last 6 months of last year was a crazy
demand was very,
place
very,
to be
very
in the
high,
gold
wasn't
market.
it?
Even for us, me and you, Jay, we saw it firsthand. It was a crazy time.
Let's finish on a couple of positive notes.
Yeah, let's do it.
What are you most excited for in 2026?
Well, honestly, it's just clarity. Whether it's inflation, debt, geopolitics, something gives eventually. I mean, I would like to see what's going to happen here in the UK. You know, gold doesn't need to predict the future. It just needs a level of uncertainty to stick around it, and which definitely doesn't seem to be going anywhere, to be having a good year. Me, myself, I'll be looking forward to learning how to play golf. I'm not that great at the moment, but I'm trying.
I could give you a few lessons, mate, no problem.
Someone needs to, because it isn't coming together the way I thought it would. And yeah, I'm looking forward to just seeing where this market can keep going.
And what are your final thoughts?
Gold isn't about getting rich quick. It's about not getting poor slowly. It's an insurance, it's discipline, and it's a reminder that the real wealth doesn't depend on trust in the system that changes every election cycle. Whether that's UK, US, all of these countries and their political parties have a say in financial systems and economic and fiscal policy. Gold doesn't care. If anything, it thrives on it because it needs uncertainty to fuel it. So I would say, like for the 5,001st year, I guess, gold's here to stay.
2026 is shaping up to be a year of economic and political strain unlike anything we've seen. Stock markets could falter, sovereign debt could spiral, and geopolitical tensions could ignite further. And through it all, gold remains the constant. Last year, it proved its strength, and the factors driving its rise aren't going away anytime soon. Remember, if you want more information, you can go to guide.directbullion.com to download our free guide to tax-free gold. If you're listening on YouTube, remember to like and subscribe so you never miss an episode. Or if you're listening on Spotify or Apple Podcasts, remember to give the show a follow so that you never miss an episode. Also, leave your questions below in the comments and we'll answer them in the next episode. Thanks for listening to The Bullion Advantage. Stay informed, stay prepared, and most importantly, stay golden. The purchase of gold does not constitute an investment or offer financial returns. Gold is considered a store of value and not an investment product. Past performance of gold is not indicative of future performance. Prices and values of precious metals can fluctuate and are influenced by various market factors. Direct Bullion does not provide investment or tax advice and recommends that you conduct your own independent research before making any purchasing decisions.